The latest economic data spooks markets. I'm Lisa Bernhard with Reuters, and joining me today to explain it all is Eric Diton of the Wealth Alliance. Eric, what a difference a day makes. Yesterday, we had the Fed indicate that they would perhaps start cutting rates in September. Stocks rallied, and we had some analysts saying, well, the soft landing looks like it will be achieved. And now today, we had the latest jobless claims. We had manufacturing data that came in. Stocks took a nosedive. And now we're seeing some analysts wonder whether maybe the economy will slide into a recession. So what did we see in those economic reports today that sparked this major stock sell-off?
Two major data points that are just pointing in the same direction, and that's economic weakness. We're looking at the employment numbers, initial jobless claims, and that was higher than expected. 249,000 was supposed to come in at 235,000. These are initial job. These are people just hitting the unemployment, the jobless claim. They're filing for the first time. So that's a definite point of weakness. The other is the ISM manufacturing index. Now, that's a measure of manufacturing in the United States and demand. It looks at a lot of things, backlog, production, et cetera. It was a weak number. It was the fourth month in a row of weakness. But let's be clear, it's been weak 20 out of 21 of the last months. So this was just a weaker number. So we saw two data points that both are sliding in a negative direction with regard to the economy. And, I would say to Jay Powell, careful what you wish for, my friend. You are fighting for the 2% inflation. Well, to get to 2%, there's collateral damage. And collateral damage is a slowing of the economy. Now, he wants that soft landing. Soft landing means we slow the economy down, we bring down inflation, but we don't go into recession. But we have had an inverted yield curve now over 500 trading days, one of the longest ever. That often is a precursor to a recession. Not a guarantee, but it's one of those signals. So market's starting to get a little nervous, and there was certainly an opportunity for profit taking.
So markets right now are betting that the Fed will lower rates by 25 basis points in September. Does that maybe become higher? Is it maybe 50 basis points? What do you think?
Yeah, it could be. Jay Powell's a fan of saying he's data dependent, and he is. And I thought there was an outside shot he might cut in this last meeting. We kept saying September, but we really saw the CPI was down 0.1. I mean, we hadn't seen that in years. And I thought he might just think about cutting. I think he missed the boat, personally. I think we should have seen a 25 basis point cut this last time, and he might catch up. I think, Lisa, I want to see what the employment data looks like this Friday. And that's definitely something the Fed watches. The Fed watches inflation and employment very closely. And I think if we saw a very weak number, he might very well cut 50 basis points in September. But we're just going to have to see. He is truly data dependent, and we don't know what that data is yet.
We're even seeing the Russell 2000 small cap index plummet more than 3% today. So that's bucking the storyline that we've seen recently, which is a rotation into those small caps and out of big tech, mega cap tech companies. Is the market overreacting, or do you still think that we will see that storyline of that rotation into small caps going forward? What do you think?
Lisa, in my previous interviews, I have talked about small caps. I've talked about the fact that they are cheap and they were due to catch up. Now, let's remember, we are coming off a 10% move in the Russell 2000 in the month of July. 10% in a month. Huge outperformance versus large cap. The S&P was up like 1. So if you get weak economic data and you just had a 10% move in small caps, hey, 10% in a month, I'll take that.
Okay, I want to talk about something that appears to be a problem for Kamala Harris and Donald Trump, both of them, either one of them, no matter who gets in office, right? And that is the federal debt, how much this country owes, and the deficit, right? The difference between what's going out versus what's coming in. I want you to talk, because this is not a very sexy topic for a lot of people, but I want you to explain how staggering those numbers are in layman's terms and why that is unsustainable for the health of this economy going forward.
Sure, it's a great question, Lisa. And let's just think about the numbers for a moment. We are at $35 trillion of debt. I know we added approximately $8 trillion during the Trump administration, and I don't know the exact number under Biden, but also substantial. And so our debt that we're paying, the interest on that debt is now about 17% of our federal spending. Just a few years ago, it was mid-single digits. So that interest is now sucking away money that we could use on whether it's defense or entitlements, education, whatever it may be. That money now has to go toward paying off the debt. The deficit is what's coming in, what's going out. What does our budget look like? And it's a $1.9 trillion deficit, which just means we're just adding onto that debt. Lisa, I have yet to see a credible plan to deal with this debt from either side. No one wants to campaign under debt reduction. So yeah, I'm going to raise your tax and I'm going to cut your benefits. Vote for me. You're not winning. And that's part of the problem. At some point, all those foreign holders of U.S. debt, as well as domestic, may just demand a higher rate of interest for the risk of owning debt in a country that has no credible plan to reduce it. And if that happens, it doesn't matter what the Fed does on the short end. The short end is the Fed. The long end is fear and greed. And those rates will go wherever the market dictates in order for us to borrow. We can't let that happen. We've seen that. We've seen that with Argentina and Venezuela, et cetera. That can't happen in the United States as the world's reserve currency. We can't lose that kind of credibility.